Hello, everyone. I am Jeremy Morales, the director of the BSc Accounting and Finance at King's College London. And we have organized with Andrew McFall a panel session to speak a bit about what the BSc is through a panel session. So we have three panelists, Manuel Rodriguez, who is a lecturer in financial management and teaches the principles of finance in the first year of the BSc, Crawford Spence, who is professor of accounting and teaches capital markets and financial institutions also in the first year of the BSc, and Rita Samiolo, who teaches management accounting, who is lecturer in management accounting and teaches management accounting in the second year. Andrew himself is the deputy director of the BSc and teaches various modules, including the introduction to financial reporting in the first year. So today we are going to address several issues, and especially how the current crisis is an illustration of how technology and new developments in accounting and finance are disrupting the whole industry. We are going to speak first, each panelist is going to speak for 10 minutes each, and then we will take Q&As from the crowd. So I'll start with you, Manuel. You used to be Secretary of State for Finance in Portugal. And so I wanted to take that as an opportunity for you to explain to us what you think the current crisis had as an impact on public finances, and especially if you could mention the different aspects, different countries, how they have been impacted. And I'm thinking about Southern Europe, as you were working in Portugal, how they can absorb major demand in social security, while at the same time seeing big economic declines in their respective economies, with many economists now suggesting that even in the best case scenarios, it would take 2 to 3 years for GDPs to pre-COVID-19 levels. So what do you think about countries like Portugal, Italy, Greece, and Spain? Are they going to be in a good shape enough to go through this recession? Are they in better shape than in 2009?
Thank you very much, Jeremy. It's an honor and pleasure to be here with you and to be able to have this conjoint reflection. Well, this virus does not pick up on specifically southern countries. It picks on all countries, and we really need to have a conjoint global problem that has to be solved collectively. We know that in the former crisis, it was a crisis that affected especially a few countries, mostly in the south of Europe, and we know 3 of those countries ended up in a bailout, which included Greece, Ireland, and Portugal. But this time, the reality is different. We are all being affected simultaneously, north and south. And the way we are getting together to answer the big challenges imposed by this virus has been by front-loading what we call it monetary policy. The European Central Bank has been very emphatic in addressing those issues by pouring substantial amounts of liquidity. And 2 days ago, Germany and France had joined forces to push up for a 500 billion euro recovery fund that helps to boost the effort to create a coordinated European fiscal response. We know there is a difference in this crisis when we compare to the former one. Southern European countries, they have gone through a major public management turnaround program in the last financial crisis. And these countries, they have learned a lesson. And the lesson means that we cannot compromise public finances at any cost, which means if you look to corporations, if you look to households and corporations, they can be bailed out. But what happens when the government loses the confidence, when the government loses market access? Who can bail out a government in a situation like the one we are experiencing, when all countries all over the world are struggling? So that's why if you look to the public accounts and to the response of Southern European countries, it has been more shy, more timid than when we look to Germany or when we look to other countries which have a stronger fiscal position, right? So this is very important in the sense that yes, governments, they have to support the economy, but up to the limit where they can still keep their market confidence. And that's the key lesson that we have learned from the last financial crisis. And that's why we experience to have, or we are actually experiencing stronger and more emphatic responses in the center of Europe with more public investment to support the economy, because yes, there is more fiscal space. And that is precisely the matter.
Thank you very much. So if I understand you well, the main difference is in the last crisis, we understood that putting vast sums of money into the economy went at a cost, like in this country, the austerity measures that followed. So you think this time we are better prepared, if I can summarize you a bit simply?
Yes, let's say in this time, in the last financial crisis, we learned what happens when governments stretch too much their public finances, running very high deficits for far too long. Large public sector deficits cast doubts on sustainability on government finances, and that cannot happen again. The 2008 crisis ended up not only in the bailout of households and corporates, but also in the bailout of countries. And that is what precisely we need to avoid. Who can bail out the country in the present landscape? It's very difficult. So in this crisis, most countries are in trouble at the same time, and we need to guarantee that collectively all countries work to maintain market confidence and do not lose market access. It will be very challenging for Europe if some country in the region would be struggling in terms of market access. So we need to calibrate the public response in order to match those concerns. And that is happening. At the same time, we see that an energetic and synchronized action of the European Central Bank, not only of the European Central Bank, but that action spans all central banks in the world, including the Bank of England, the Federal Reserve. And yes, again, this time the response has been much quicker than in 2008 and much more synchronized. So that's something which is also very positive.
Just to say, if you've got questions for Manuel or any of our other panelists, please put them into the Q&A. So we're going to discuss these at the end. I've got one great question already here from Franz.
Thank you, Andrew. And thank you, Manuel. So yeah, I think it's important to note that there is increased solidarity between countries and very good ideas about how to respond collectively and everything. Before the 2009, 2007, 8, 9 crisis, there was a divide in Europe between Western Europe and Central and Eastern Europe. After the crisis, there was a divide between Northern Europe and Southern Europe. But what we know a bit more now is that some countries, including Portugal and Ireland, responded very well, whereas other countries that I will not name responded less well. Do you think that here again we have this divide? Do you think like some countries are in a better position to respond, and do you think it will be the same divide? Do you think the South is going to suffer the most?
I would say if we look to the healthcare response, yes, in the beginning we had a few countries that were more prudent and that were more successful, and that included also Portugal. But now, mostly, we have been, on average, able to contain the progression of the virus. Now, which means, as an aggregate approach, Europe, after a few months with more challenges in a few countries, yes, now we are seeing the numbers the progression numbers of the number of active cases of COVID-19 to slow down. And we expect the region to be in a better position. Now, the critical point is, how do we expect the world to look like after the pandemic from a finance perspective? And how can our graduates position themselves during this market turmoil and afterwards? I would say that the world after the current pandemic will be a more vulnerable place from a finance standpoint, as the levels of public and private debt are going to fly up. And let's see how do we get there. First, we need to understand how the world looks like at the end of the pandemic by looking at where do we stand today and how are public and corporate finance going to evolve. First question, where do we stand today? We entered the current pandemic with a record high level of global debt. The global debt to gross domestic product ratio at the onset of this crisis was or had hit a new all-time high of more than 320% of the GDP in the beginning of 2020, which means that the level of indebtedness was 40 percentage points in the beginning of this crisis when we compare to the beginning of crisis 2008. So in terms of, as a finance standpoint, we are more vulnerable. Second, how our public and corporate households' finances are going to evolve. Now, we know that through the lockdown process and approach, we were able to relatively successfully contain the progression of the virus. But we also know that each day of a lockdown, an economic tsunami is gaining speed in the line of the horizon. So with the lockdown, stream of cash flows of families and the stream of cash flows of corporations, they have been disrupted. And the intensity of the crisis has been amplified by the fact that we are facing both a supply and a demand crisis. Now, to avoid this cascade of financial distress and bankruptcies, most governments in the world have been forced to bail out corporations, to bail out families. And so we are expecting the level of public deficit and public level of indebtedness to increase dramatically. So by coupling all these effects, how do we expect the world to look like following the pandemic from a finance perspective? We expect, if the world was already very indebted, it's going to be, the global debt burden is going to rise dramatically through 2020 and 2021. And it's going to be, we're going to have even more debt by the end of the pandemic, which means that then the relevant question would be what might this mean for our future graduates and for the careers in finance? Well, with a so high level of indebtedness in corporate and public sector, there will be a high demand of finance experts with a finance and an accounting background that can help to turn around the situation, that can help to mitigate the crisis and following the pandemic, it can help to manage the huge amount of debt that is going to be around for many, many years. So the 2020 financial crisis has been taking most companies by surprise. And from one day to the other, finance teams found themselves in a very challenging position by having to plan ahead, manage tight cash flows and liquidity forecasts, draft new budgets, create new models, which means there is clearly a need for finance experts to help to mitigate the impact of the crisis and for well-rounded individuals with a background in finance and accounting. And there's where our BSc is actually developing all those skills that will be and that are necessary going forward.
Thank you, excellent. If I may, just one last very short question. I think this crisis has showed that to answer a pandemic or any kind of crisis, you need first to have operational response like healthcare in this case, but also a way of funding the response. And here, this is where finance comes in. When you worked, I'm guessing the main results came from financial markets, capital markets. But if we look at history, and I know that some politicians have abused of the war metaphor, but still at times of war, governments tended to ask their citizens to support, not markets. Do you think we are going to go back to a different way of funding governments, not from the market, but from the citizens directly, or maybe the banks or something like that?
Jeremy, that is a really relevant question. We need to be less reliant on financial markets itself and to be able to what we call disintermediation. And that's why the governments, they have developed programs of issuing public debt that is subscribed directly by citizens. That is called certificates of treasury that will develop in Portugal in the last financial crisis. And this is a very relevant instrument that we need to develop, not only in Portugal, but across Europe, because it's easier for citizens that live in a country to invest their own savings, basically on financing the country and getting a fair return, than having a set of international investors that are less that are less resilient and that are investing from a distant place, investing on the country. So yes, you are precisely touching a key element, which means there is the need to ramp up the programs of issuing debt addressed to citizens. And this program is already very developed in Italy, but in Portugal we have space to increase. We have about 20 billion euros that is financed directly through citizens, but we need to scale up the program. This program is about a small portion, is about 8% of the total level of debt in Portugal. In case of Italy, it's much higher. And in other countries such as Ireland or Spain or even the United Kingdom, there is space to increase the level of subscription of those saving programs addressed directly to citizens. And that is a critical action plan going forward that we'll need to develop.
Thank you very much. Let's move on to the second panelist, Crawford. And to start, Crawford, of course, all crises are problematic, and when economies crash, no one is very happy about that. In the last crisis, we saw that also some people lost their pensions, for instance, because their pensions were invested in some specific funds and everything. And during this crisis, many people have also commented on the performance of various funds. Could you tell us more about asset management, what it is, why we want to speak about that now, and what do you think, how well they performed during the crisis?
Okay, yeah, sure. Thanks, Jeremy, and welcome to everyone who's attending this webinar. I can see from the names on the attendee list that people have signed in from literally all over the world, which is fantastic, and I think really reflects the international atmosphere we have at King's College in any case. So it seems like if I can judge on names alone, it looks like a class list I would normally have in the Strand Lecture Theatre. Yeah, so Manuel gave a more macro, a really magisterial, I think, macro perspective on how governments are responding to the crisis, looking at fiscal policy. Jeremy, you've asked me a question more about asset management, which is a little bit at a more micro level, but nevertheless is a very important industry, and I'll try to flesh that out a little bit over the next few minutes. So asset management, sometimes known as fund management, usually takes place in institutions like investment banks. So, maybe your Goldman Sachs or your JP Morgans of the world. And what we have within that industry or area, if you like, is a broad bifurcation. There are two broad ways of managing assets. We have active fund management and passive fund management. Okay, so active fund management is when you as an investor, you give your money to a group of people, usually a bunch of guys, usually a bunch of men, often white men in an office, who decide to invest on your behalf, and you often pay them quite a lot of money. Sometimes say 2% of the overall amount of money you give them, they take each year in fees, and then maybe a top slice of 20% of whatever returns they manage to make, if they manage to make any returns for you. So that's active fund management, and that has been the norm historically for a very long time. And some people have been very critical of that, because actually it turns out that these people are not so good at earning money for investors. And we understand this because we now have some really good data comparing active fund management with what is known as passive fund management. So passive fund management, you still give your money over to a financial intermediary, a middleman of some sort, but they are not performing what they call active fund management strategies. Rather, what they're doing is they're maybe setting up an algorithm or a computer program or an index tracker fund, which really just allocates your money automatically into different pots to follow the average of an index, whether it's the FTSE 100 in the UK or the Standard & Poor's 500 in the US or the CAC 40 in France, whatever. There are lots of different indices you can follow, and those passive things require very little human intervention, and they're much cheaper as well. Instead of paying 2% and maybe a 20% top slice, you might pay something like 0.1% or 0.5%, or literally a fraction of what you would pay to the active fund management industry. Now, for a long time, the active fund management industry said, well, fine, we can make more money. We have expertise that just following the index does not have. We can literally beat the market. But it's been increasingly apparent that this is not the case, that the vast majority of fund managers, and this is still not widely known, and this always surprises me that a lot of people don't know this, the vast majority of active fund managers underperform the market. Okay, so you're literally better off giving your money to one of these passive, cheap funds that allocates your money in a very mechanical way. You've more chance of making money, because after the fees, the active fund manager doesn't create value for investors. So in this respect, financial intermediation in the active sense is something like a tax on society. And I found it interesting that Manuel used the phrase disintermediation, calling for the need to have disintermediation. He was talking about that in a slightly different context, but we can use that here as well, that there have been arguments that we should reduce the role of financial intermediaries, that the money that goes into the finance world is not always best allocated. But in the passive context, it tends to be better value for money. However, the conversations that you would have with active fund managers, and I speak to them a lot as part of my research, they would say, well, okay, fine, we underperform the market, but that's because it's a bull market. When we reach a crisis or a bear market, you'll really see the value of active fund management, okay? Because if you're just following the index like a passive fund does, then if the index is plummeting, then your funds are going to plummet as well. And the passive fund, the algorithm has no response to this, yeah? And now what we currently have, and I'm going to share my screen here briefly, because we have, with the COVID-19 crisis, we have a fabulous empirical study or experiment, if you like, which shows exactly how active funds have done in comparison with passive funds in a bear market. Yeah, so here's a bit of data I can share with you. Here is some US data, which shows the performance of active versus passive funds from 2013 onwards. So this is longitudinal, okay? And basically anything above the line here, 0 is the baseline. Anything above the line is where the active fund management industry outperforms the passive, okay? And this is comparing it to Standard & Poor's 500 index. And anything below the line is an instance or a particular quarter, where passive funds have outperformed active funds, yeah? So what you can see from 2013 onwards to 2020, which is about, was it 32, 36 quarters, we have just 6 or 7 quarters where the active fund management industry has outperformed the passive fund management industry. And you can see laterally, the first part of 2020, data's emerging, they've really underperformed. Okay, so that's some US data. And then if we look at UK data, which is looking, I think, more recently, over the last few months or the last year or so, we're looking at different forms of UK active funds in comparison with passive funds, and 0 is the baseline here. If we're going to the right-hand side, then they've outperformed the passive, but they're all on the left-hand side, so they've underperformed the index. And if you're investing in all UK companies, just equities, even if you're a UK fund investing in Japan or emerging markets, the performance is a bit different, but the same consistent pattern emerges, is that the active fund management industry still, even in a bear market, with the impact that COVID has had, is underperforming passive funds. Okay, so this, that get out of jail card that the active fund management industry was claiming that they had in their back pocket hasn't really come to fruition for them. So pre-COVID, active fund management industry was underperforming the passive fund management asset managers, and during COVID, that seems to be the case as well. So what this suggests is that the flow of funds in financial markets towards passive funds, which has really increased dramatically in the last decade, is likely to increase even more. Now, what does that mean? Does that mean that, to get a job in finance in the future, you just need to learn some computer programming and learn how to write an algorithm and set up an exchange-traded fund? Well, no, not necessarily. That's one strategy for you. But what it does mean is that conventional stock picking approach is increased, where you're relying on your own judgment and you think that you have the tacit embodied expertise to beat the market, is increasingly not accepted as being the case. So what we're seeing is that people that are doing well in the fund management industry are those that have what we would call a hybrid form of expertise. They maybe have some finance knowledge, and they also have a little bit of data science knowledge, a little bit of computer science knowledge, not necessarily too much, but they can combine those different things to adopt a more holistic perspective. Those tend to be embodied more in passive funds. Does that answer your question?
Yeah, thank you very much, Crawford. So if I understood well, that means that first we have a change in the way fund management works, and especially active funds are not performing as well as we thought they would, and that questions the very expertise that we are giving to our students. But you're saying, no, actually, that means that we need to train students that are also trained in different forms of expertise, including computer science and all that. Maybe we can speak more broadly about the notion of the expert, and this idea that you could be an expert before, but now you need to be more versatile is very interesting for us, because we try to provide a very diverse training to our students. But maybe also you could link to the importance of not being a machine and being trained in the humanities, for instance, for our students.
Yeah, sure. Okay. Yeah. So, I mean, what forms of expertise are still valued in this field? And, you know, firstly, it's important to recognize, you know, to reinforce Manuel's point that coming out of this, finance knowledge and those with financial expertise are going to be highly valued, because, you know, those forms of expertise are valued in boom times, but in bust times, he's suggesting they're even more important. So that is not disappearing. What I'm seeing is certain aspects of the finance industry, of active fund management, I think are under threat. And that does have implications for the forms of expertise that are valued in the job market and that graduates and students should be accumulating when they're in universities. So this big growth in passive doesn't mean that everyone is going to just have to, you know, write code all the time and be experts in computer science. Actually, it's a combination of different things. And, you know, there was an announcement this week or last week by St. James's Place, which is the UK's biggest asset manager. They are investing massively in a series of what they call passive plus funds, which is halfway between active and passive. So passive in that it follows the index, but it still needs monitored by humans. And the plus element means that you still need to be able to make judgments, have a sense of where the market's going, whether or not the algorithm or the computer program that's allocating assets for you is somehow not picking up on things correctly. So there's a more hybrid form of think asset management that's going to, I think we should keep our eyes on in the future. I mean, when you talk about expertise or knowledge coming from diverse areas like the humanities or even the broader social sciences or wherever, I think this is where you see it being very important, and having very rounded individuals who can see things from multiple perspectives and make more intelligent decisions as a result. So, you know, it's not just hard skills or soft skills. It's always a combination of those different things, and that will always be the case in the future as well. But, you know, I'm only talking about one link in the investment chain here. There are many links in the investment chain, and, you know, finance is a big area. It's not going to disappear overnight. It's not shrinking at all. I mean, there are still lots of jobs that need to be done, whether it's back office work, whether it's to do with execution, whether it's to do with trading, brokerage. You know, there's a very diverse range of different jobs that are out there. And while some of them are technical, some of them are very relationship based. And most of the people I speak to in the finance world, the vast majority of the work they do is relationship based. So being able to, you know, conduct, you know, meaningful, intelligent conversations with people, being sensitive to what their needs are. These are what, you know, what we call the soft skills, and those come from a much more rounded education, which I think is certainly the type of thing we try to offer at King's by offering a more social science based course. So yeah, I would say that in spite of this move towards more technology, more algorithms, more computers driving a lot of things in finance, the need for relationships is almost accentuated or increased at the same time, which is kind of an interesting. So you need better hard skills and better soft skills at the same time.
Very interesting. Thank you very much. And I just know that you've actually been part of a delegation to advise 10 Downing Street for our international crowd. This is where the Prime Minister works. And you were asked to speak about societal responses to technological innovation. Do you want to speak a bit more about that?
Yeah, I mean, we could say a little bit about that, and then just takes us into the policy context. So as part of a broader team at King's College, which came from different faculties, and, you know, King's is one of those great universities that's very close to government in the UK. It's always had a historical link to ministers and to the monarchy. So, you know, you find yourself exposed to, you know, to ministers and policymakers and special advisors. So I was lucky enough to be part of a team of King's professors and other experts who went to Downing Street a few times to advise the Prime Minister's special business advisor on artificial intelligence and technological innovation in the economy. And the big thing that the government was concerned about was that technological innovation was happening too quickly. And they were worried about what they were supposed to do with, for example, a 50-year-old truck driver who, you know, was suddenly going to find that their job was going to be automated, and we're going to have driverless cars. There's no need to have somebody drive trucks anymore. That's pointless. And to reskill somebody in their 50s, you know, they're not going to go away and start, you know, taking courses on data analytics or data science. You know, the worry was they were just going to be left on the scrap heap of the next to the job market. But what we were trying to get across to the government there was that many of these anxieties are unfounded. While technological innovation is continuing at a rapid pace, actually society runs on the basis of habits and routines as well, and things don't change as quick as you think they might. Just because the technology is there doesn't mean people are prepared to adopt it quickly. You know, otherwise we would have had driverless cars years ago. You know, people are scared of driverless cars, and, you know, we could adapt our traffic light systems and everything to have these very quickly. But, you know, because of social anxieties and routines and habits that we have built into social structures, these things don't happen so much. So, you know, technological innovation is very important, and I think we're at the forefront of that at King's, and we're trying to tool up our students with it. But at the same time, we're trying to give them this social sensibility that technological innovation doesn't get implemented of its own accord. Okay, it happens within social systems, and we try to help them understand that broader social context, within which technological innovation takes place. So really, what we are trying to cultivate at King's are really rounded individuals who have, you know, a combination of hard skills and soft skills, and, you know, really good valued expertise, but also that wider, more abstract ability to conceptualize and theorize about how social change takes place. And that critical abstract reasoning combined with that hard technical ability is what we find that graduate employers are most interested in. And that's the hardest thing to get graduates to do, to combine that different skill set. But I think what we've designed in our BSc program speaks very closely to that diversified ability to think.
Thank you very much, Crawford. Let's now move to the third panelist, Rita. Rita, you noticed that some of the current developments actually call for an increase more than a radical change in what was already going on. Can you develop a bit on this idea?
Yes, definitely the pandemic has sort of perhaps intensified certain trends that have been underway in accounting for quite some time. So yeah, we moved from the macroeconomic and sort of global finance discussion we had so far down to the ground level of accounting, where the basic numbers on which those macro systems are built are produced. So as far as accounting is concerned, there's been quite a lot of interest and clout around technological change for some time, with large accounting firms at the forefront of investments in this area. And it seems that some developments, some pressures that the pandemic is putting on the market are certainly going to sort of speed up perhaps, or anyway intensify those trends. So why are accounting firms investing in new technologies? Well, first of all, technology promises to allow for efficiency gains, essentially to cut costs and add value by means of cutting costs, because the promise is that you can automate the more mundane or routine part of accounting work, and so free accountants to focus on those higher value forms of work where professional judgment is required. And the second big sort of motivation for technological investment in accounting has been the attempt to create competitive advantage by offering clients more customized and unique solutions as a way to gain new clients in an environment where, for example, when it comes to Big Four accounting firms, competition is intensifying. And certainly at times such as these, where the market is contracting, the promise is to be able to perhaps retain clients. So a massive second pressure is to use technology as a way to differentiate one's offer from that of competitors. With the coronavirus crisis, of course, when the survival of many businesses is threatened, the pressures to cut costs and retain market share are massively intensified. So we can probably see that technology and investments in technology are going to become even more interesting than before. This is certainly true, at least for the big accounting firms who have been able already to invest in new technologies in the first place, as these don't come cheap. And actually there is a sense that you can gain if you read reports by the Big Four and by the profession, but also that I got in interviews that I conducted with some audit firms. There's a strong sense that technological change is difficult and costly, and that it will take quite some time to reap the benefits that these new technologies are supposed to deliver in terms of efficiency. So perhaps there is a tendency to oversell or overestimate the efficiency gains you can achieve, at least in the short term. Obviously, another set of pressures that are obviously being intensified by the coronavirus crisis, which we are all very familiar with, is the possibility of working remotely, or actually the necessity of working remotely. People are asking whether we'll ever be going back to our office work as we knew it, and if working remotely is going to become the new normal. So this possibly applies to all sorts of businesses, as we know, universities included. And working remotely is a trend that has started pre-pandemic, with technology allowing to, in the case of accounting firms, to delocalize the more mundane, low-cost parts of work to cheaper locations around the world, and to share resources geographically in distributed teams interacting online, as well as reducing the need to meet the client, for example, face-to-face. Though the story here is also that with the advanced knowledge that new tools like data analytics is delivering, the interaction with the client, if less frequent, is becoming more interesting and more meaningful. That's the story you hear. So clearly the pandemic has intensified the appeal of these new technologies, both in terms of their cost-cutting promises, their client retention potential, and of course the possibility or the need of working remotely. Having said that, there are some significant challenges that firms are experiencing when introducing new technologies, and I think as accounting scholars and as accounting students, we need to be very aware of those. And what it seems is that while it's easy to invest in new technologies and acquire these new tools if you have the resources, their implementation, as usual, is more problematic. And it seems that the firms are less prepared to gain the human skills that you need to accompany these new processes of technological change. So, for example, an obvious challenge, as we've heard also from Crawford, is the integration of IT expertise with traditional financial and accounting expertise. So here what firms are doing is trying to acquire this talent in the market, perhaps, but there aren't that many people out there who can successfully hybridize these two forms of expertise. And so mostly firms are also trying to retrain and reskill their employees, making finance trained employees more IT literate. Having said that, there's also additional organizational challenges in this respect. So I was reading recently a study done in Germany, which found that only in half of German companies, chief data officers, which are these new senior management role that is emerging out of the explosion of data, only in half companies, the chief data officer reports to the CFO. And so we observe a separation between those who are responsible for data quality and information systems and those who are responsible for financial data. And this is a challenge because traditionally, the CFO, the Chief Financial Officer, was the single source of, we can call it, truth about the financial situation of the business, the main validator of accounting and financial numbers and of their interpretation. With the changes in IT brought in by new technologies, IT systems are becoming much more decentralized with potentially much more ability to access data analytics, business analytics, information in real time across the organization. And so the information system is becoming much less hierarchical, challenging the traditional role of accountants as the main controllers of information flows. So essentially what we're saying is that the explosion of data and the arrival of new technologies is also creating a new division of labor between finance and IT that needs massive coordination efforts.
Very much.
I just wanted to add one thing, that it's not just a matter of organizational structure and reporting lines. What is also one clear challenge that most firms are reporting. So I was reading, for example, a joint study by the Chartered Institute of Management Accountants and KPMG that surveyed various business in different industries worldwide. And if you find reports by others like Deloitte going mostly in the same direction. Typically, when you introduce new technologies, the human element, so to speak, is underestimated. So, as I said before, knowing how to support employee through the transition required by the introduction of new technologies is problematic, not only in terms of giving them the IT skills that they may need to interface or to work in this new high-tech environment, but also the interpersonal skills that are needed for, essentially manage change.
Thank you, Rita. So what do you think are the consequences for our students in terms of career, for instance?
Yes, so, what are the accountants of the future going to look like? What are you guys going to have to focus on in your years at university and then once you enter the job market? So I would say that in many ways, the accountants of the future are probably going to look like the accountants of today. And what I mean here is that the role of accountant has been changing for a long time. In the past, the stereotype of the accountant was this financial specialist, mostly concerned with reporting, whether internal or external, working almost as a separate function and in isolation. But this has changed already for quite some time now. Today, accountants are known as business partners who work in interdisciplinary teams, and they have become much less specialists and much more generalists in the sense that on top of their financial expertise, they are to be much more aware of strategy and how to support the company's business model. And they need to be conversant with marketing, design, technology in order to support all these different functions around the business and often the client as well. So they have this strategic client interfacing role that was totally absent in the past. So that means that accountants need to have strong interpersonal communication skills. They need to be experts in communication, not just numbers. They need to interpret numbers for others, adapting the interpretation to the information needs of their audience. They need to engage in complex judgments. They need to make their work much less routine and much more so-called value adding. And this is true of management accountants. It is true of auditors whose role as business partners and whose ability to support the client also at the level of strategy making and strategy implementation has been around for quite some time. So technology is further reinforcing this trend, as we said before, because it frees accountants from low-level routine work that used to be done by early career accountants. And it's orienting accountants much more towards this role of business partners, much more value-adding, strategically oriented role. And so here we encounter one difficulty because technology is now partly replacing junior accountants. And so a significant issue for entrance to the profession and also for those who employ them is that many junior accountants will lack practical training on the job in the fundamentals of accounting. In the past, you used to learn the fundamentals on the job and then move on to more senior roles like business partner. And that entry-level work, even if considered very dull, still helped to make sense of the business and was regarded as actually useful then to transition to more complex and more senior jobs. So the challenge now is to support learning in early career, even in a world where technology is replacing much of the actual work being done. And also this means that there will be a lower number of junior accountants than we had in the past, as the organizational structure of the firm changes from the traditional pyramid, whereby you had a large base of trainee and junior accountants, part of whom then progressed to more senior jobs up the pyramid, to what is now described more as a pentagon. The pentagon represents a more networked way of working, where people shift back and forth from different teams, work collaboratively in a much less sequential and more interdisciplinary way. So you see in this sort of environment, the accountants, business partners will need to become, as we said before, more conversant with IT, but also much more oriented to interdisciplinary work, much more adaptable, open to learning throughout their life and upskilling themselves throughout their careers, and to gain a lot of flexibility that is required by these new work structures and patterns. So you need also quite a lot of mental flexibility and appetite to have a broad field of vision, which means for your training education to again diversify your skill set and your interests. You need to be a generalist as much as a specialist. And this is something that you probably will find also in debates about the current pandemic, that the kind of crisis management that this pandemic has thrown us into reinforces this need for, let's say, flexibility and agility in the face of uncertainty and complexity. So to reinforce what Crawford said before, you will have to embrace both hard and soft skills, with number crunching, coding, but also communication being all equally important. And to cultivate communication, essentially you need to practice reading broadly, writing, you need a strong, let's say, social science orientation to accounting. You need a behavioral and mindset change as well, embracing complexity, high level theorizing and so on.
Thank you very much. Well, that was fascinating. Thank you for all three. And now, Andrew, can we take some questions from the virtual room, please?
Yep, so the first question comes from France here, and he's asking, I could probably direct this one at Manuel, what do you think about the new Marshall Plan? It's put in brackets, so saying that obviously it's emerging, suggested by Germany and France. So this sort of, and I think this sort of breaks into the sort of wider question of something like the European Union with a sort of joint central bank system, how this works, and what your views is. Maybe you can answer that sort of as the kind of, from the perspective, particularly as a former Minister of Finance for Portugal, what your perspective is on that.
Shall I go ahead? Yes. Please. Perfect. Thank you so much, Andrew. So what is relevant in this crisis is that we don't have individual countries overspending and increasing their credit risk. As they increase their credit risk, markets, if it's a country with a very high level of public indebtedness, markets might become more nervous, and the ability of the company to refinance itself might be at risk. So the advantage of this plan, it's a conjoint plan of the European Union, where the plan is going to finance on a grant approach, which means the money is going to be not lended, but it's going to be given to the most affected countries without a need to reimburse those financial resources. So this, together with more than €1 trillion of funding, so 1,000 billion euros that the ECB is going to provide by acquiring assets on the secondary market, is an important help that has been crafted. Let's call it a new Marshall Plan, of course using other tools that we have available now, by having the Eurozone, a single currency block and so on, that will help to reduce what we call it financial fragmentation, that helps by the fact that financial markets perceive the credit risk of countries such as Germany as very low, versus the credit risk of countries in the south of Europe has relatively high, driven by the fact that they have a high level of public debt. So yes, this Marshall Plan, I don't like to call it Marshall Plan, but yes, this recovery plan that was crafted by France and Germany still has to be approved. But of course, they are very strong, two very strong countries in the Union. So I really believe it's going to go through the Eurogroup, and it's going actually to be a very strong help to reestablish the confidence. And that was actually the reaction of financial markets. Financial markets have been mostly on the sovereign debt. We have seen in the last few days a compression of the yields of mostly countries in the south of Europe, which means there is a confidence that this plan will help to reduce the differences that you see within the euro area that precisely derive from different fundamentals in terms of public finances, which need to be mitigated through the crisis.
Thank you. So the second question is very closely related, and it's saying, how can countries go bankrupt when their public debt is in their own currency? So this is an interesting question about, in a sense, why can't countries just print their money to sort of solve the problem? Do you maybe want to discuss how the financial markets work in that respect, how they, in a sense, act as a mechanism for really stopping countries doing that?
So I don't like to speak about bankruptcy. In the Eurozone, we have mechanisms that are in place to avoid that to happen, which means we have set a framework where countries need to comply, which means countries need to have a public deficit below 3%, and they have a framework to reduce their level of debt. And if they comply with that framework, which most countries have been complying before the crisis, then there is a framework to help in case, which is a mechanism of stabilization that will help countries if they face challenges in the financial market, liquidity challenges. So I would say the union, the good functioning of the union will prevent situations of default to happen, provided the countries follow the strict rules defined by the European Commission, which they are following. We have a waiver for COVID-19, which allows countries to overspend, because there is actually a reason to do that without having a moral hazard. But before COVID-19, the public deficits of most European countries were below 3%, and in a few countries such as Portugal, they were actually running a surplus. So that should not be a problem. But yes, when countries, they have their own monetary policy, which is not the case of countries in the Eurozone, they can of course print money. But that's the role that is being developed by the European Central Bank. The European Central Bank is printing money, between brackets, and acquiring assets. So the interest rate now is set at the 0 level, plus there is a plan to acquire financial assets, which include sovereign bonds, corporate bonds in the financial markets, to guarantee that the financial conditions are good for the region. So countries that are outside of the union, yes, they can print money, but that is not necessarily a way out, because when things are not running well, the fact that you print money will devalue your currency, will increase inflation. So there is no inflation in the Eurozone, as we know. Currently, inflation levels are very low, but a country that is outside of the union, if it takes that as an option, we don't have any problem with expenditure because we just print money. It's going to suffer. It's going to suffer inflation, and it's going to suffer a major devaluation of the currency, which will end up in losing purchasing power of their population. Because, as we know, there are plenty of goods imported that will affect, of course, directly.
Okay, one more question, which I'll probably direct at yourself as well. So, will the pandemic situation force US and China to end their trade war? Just because we've got quite a few questions, about 5 minutes, maybe just a sort of short answer to that one in terms of what's your instinct on this? Will this change trade policy for countries with the pandemic, as countries are less in a position to be picky about who they trade with?
We expect a major world contraction, and we expect the contraction of the GDP to be even stronger in Europe and in the US. So we know China is probably going to grow this year still. So if we, at the current moment, go ahead with more trade, more protectionism, we're going to hit growth. And who is going to be more affected? Probably Europe and United States, because we are going to have a contraction over probably 6-7% of GDP. So it's not on our benefit in the present situation to alienate the positive effects of having of allowing trade to flow. This is a type of equation where it's a win-win. We know that every time protectionism rules come out, all financial markets across the world plunge, including United States and Europe. So there is no clear winner with protectionism. So I think we need to unite efforts with Asia, with Europe, with the United States, with all governments in the world to be able to allow trade to flow. If we have to adjust some things, okay, it needs to be discussed with countries. But protectionism is not clearly the way out because it's we're going to pay a higher price in market confidence and basically in growth. And we are not in a condition to do that given the large turmoil that we have. So we need solidarity, we need to support each other, and we need probably to, even during the crisis, to be more flexible, to release a part of the trade barriers that we have.
Okay, Crawford, I think I'll ask you this next one. So the question from Carolina here, she's asked, why do you think financial struggle, what do you think the biggest financial struggles will be, we'll face over the next couple of years? That sort of relates partly to asset management in a sense, or maybe personal finance more generally speaking, but what's the most obvious things that are going to be impacting kind of the average person on the streets with what's happening right now?
Well, there's obviously a big impact on employment. A lot of people are in very precarious situations in terms of their employment status. But, you know, there's a lot of discussion with Marshall plans or, you know, economic recovery plans, whatever, about just getting the economy to go back to the way it was before, you know, as if we had this amazing economy that was working for everybody. Yeah. Well, maybe we shouldn't be thinking about what kind of struggles we should be undertaking to get the economy back on track. Maybe we should be engaging in financial/political struggles to build a very different type of economy. You know, for the first time in a long time, we can hear the birds singing, we can breathe air in our inner cities, we can, you know, see clear water in the canals of Venice. And, you know, there are some positives here. You know, the economy beforehand, that still is inherently unsustainable. You know, maybe GDP is not the great objective that's always made out to be. Maybe we should be looking for ways to decouple from growth in general. And maybe now that we've been given an opportunity to reflect upon this. And in terms of people's individual struggles, you know, the governments, well, lots of Western governments have responded with, you know, furlough schemes, we call them in the UK, or some form of universal basic income, which, you know, for a long time, people on both the political left and the political right have been arguing for quite different reasons. But, you know, that's seen as something that can provide certain social and economic stability to society. And, you know, that could be potentially associated with actually working less, yeah? And maybe working less is not such a bad thing. You know, for a lot of people, going to work is a pretty shitty experience. And if they were given the choice, they would do much less of it. And that could be better for people and better for the environment as well. So that's my answer, not particularly related to asset management, but, you know, you gave me the platform, I was going to take it.
So the next question from France, which I think is probably sort of suitable for you as well, Crawford, are emerging markets going to lose, wording of this not quite clear, are going to lose on meaning for the financial industry due to the severe setback? The way I'm interpreting that is, are we going to reinterpret what we mean by emerging markets if some of what you might regard as more the emerged or the blue chip are being hit quite severely by this? Are we seeing a resetting of what we regard to be high risk investments and what we regard to be safe investments?
Well, maybe, and, you know, time will tell what constitutes a risky part of the world to invest in and what doesn't. You know, the financial system that we have is built upon a logic of accumulation, right? And, you know, financial markets, as much as I criticize the active fund management industry, they're generally pretty good at following the money and identifying places where accumulation can take place. So, you know, what constitutes an emerging market is, you know, something that generally has a limited level of industrialization, you know, and generally Western countries are seen as the high watermark in that respect. But this goes back to what I was saying previously. What type of economy is going to be constructed out of this? you know? And is it going to be based on heavy industry? Is it going to be based on renewable energy? Is it going to be based on services? And you might find that some countries that are, you know, given the label emerging market are in some ways better placed for this sort of stuff than countries that are already heavily industrialized and have certain path dependencies to the activities that dominate their economic systems. So, you know, it's a very convoluted response to, in some ways, quite a straightforward question, but I can't give anything else but that. I guess what I'm trying to say is that it remains to be seen what is going to constitute an emerging market in the future. And all of this is up for grabs, depending on what you know, struggles people choose to engage in. We have agency here, we have choices.
Okay, and just a couple of quick fire ones as we're starting to run a little bit over time. It's a question here as what about developing countries? As are these markets even more volatile? Is active investment management better? Is it perhaps best to talk about this passive plus aspect here and how this gives investors a little bit more choice than simply just following one index?
Yeah, well, I mean, I've actually seen different data on this, different studies. Some show that active is better in emerging markets. Some say it's worse in emerging markets than passive. So it really depends what you count as an emerging market and how you construct your data set. Not all emerging markets are the same. You know, Romania doesn't have that much in common with Bangladesh, really. So I don't know the answer to that question, but you know, there are multiple answers to that question depending on who you ask ultimately.
Another quick fire one here. Do you believe programming to be essential for future investment bankers?
No, I don't, right? And I don't think you need to necessarily give up, you know, sending your kids to piano lessons and sending them to computer science or coding classes instead, right? And that's not necessarily a strategy. I think you need to understand how programming works and how coding works to some extent. You need to have a sensibility towards that. You need to maybe have some sort of level 0, level 1 understanding of these things. You know, if it's your passion, then follow it. If it's not and you're not into that stuff, then just be able to speak that language as much as you can and, you know, leave the super technical stuff to other people. There's always going to be, you know, a legion of technocrats who can do that stuff better than you can. So it's important to understand it to some extent, to talk that language, but, you know, all the other stuff we've been teaching people for a long time, critical reasoning, abstract thinking, ability to, you know, think outside the box, all of that is more important than ever.
Thank you. Okay, Rita, just there's a few here. So the first one is, I think you've already answered it in part. You've sort of replied to it via the chat system. The question's asking about how IFRS will respond to the coronavirus and whether there might be even specific accounting standards developing to allow users of accounting information, people reading the accounts to maybe better understand how companies are performing, particularly kind of a year-on-year comparisons and things. I'm just wondering what your thoughts are on that.
Well, it's hard to say for the long term. Certainly in the short term, we're seeing a lot of support being given to companies on how to implement current standards in the context of the pandemic, you know, like how to adjust going concerns, opinions, how to adjust fair value measurements, which are based on market modeling at the time now of very volatile markets. So there's definitely a lot of adjustment that needs to be made in the application of today's standards. Now, if pandemic risks moves from high impact, low probability to high impact, high probability, we may see perhaps more provisions made in this respect. So we may see it enter accounting financial statements more stably. That's certainly a possibility. Let's hope not. Let's hope that it remains a low probability event. Andrew, you need to.
I realised my mic's muted, sorry. Yeah, so what will internships look like in the future? So you are co-director of our Futures Works Research Centre. What do you see being, maybe I take this question partly in line of the pandemic, but perhaps more widely with different skill sets that you've been discussing earlier? What would an internship of the future look like, and how do students stand out in these internships?
Well, in the context of the pandemic anyway, you hear now a lot about, you know, having to organize your own online internship or, you know, sort of cooperating with companies from a distance on an ad hoc project basis. So there's ways to adjust the way in which we interact with a company if you cannot be physically there. On this note, though, I would like to say that perhaps we shouldn't really normalize this idea that remote working is going to be the new normal. It's definitely going to be much more frequent, and we probably are going to be able to juggle between remote working and physical face-to-face presence. Remote working comes with quite significant challenges in terms of fatigue. It's demonstrated that our biology and our psychology are not sort of conducive to working well remotely, to online meetings all the time. When it comes to learning, whether it is in a context of education or in a context of learning on the job, the kind of emotional atmosphere, the kind of, the interpersonal engagement, the emotional atmosphere, I would call it, among people is fundamental to learning. It's how our brains work. Learning is supposed to be a pleasurable activity in the right conditions. Working online, especially when it comes to meeting people online and interacting online, is very fatiguing for our brains. There's a lot to be lost in that kind of interaction. So it's a great backup at times such as these. It's a great way to save costs, to not force people to commute when it's unnecessary. It can have, as a result, sustainability implications. We're going to use public transportation much less. On the other hand, we need to not give up physical, face-to-face interactions as much. So I think we need to learn to juggle and make these different forms of interaction complementary rather than shift completely to a new model. And again, you're muted yourself.
Thank you. So that's excellent questions there from the audience. So Jeremy, back over to you.
Thank you, Andrew, and thank you very much for all our panelists and also for all the attendants who had great questions. I'm not going to pretend that I can wrap up all the richness that has been covered here, but I'll note two things that I found particularly interesting. Just this week, The Economist asked, is this crisis going to kill globalization? And I think all three panelists have answered, well, actually, what we are going to see is partly unpredictable, but probably going to be a different kind of globalization rather than a deglobalization. I think this is interesting. Crises are rarely a clean start, a new beginning, something entirely different. It always starts with what already existed before. And we can only hope that this notion of a new Marshall Plan, and some people speak about Green New Deals and stuff like that, mean that we are going to see the emergence of a new form of capitalism that may be more inclusive, more cooperative and stuff like that. As you said, all of you, this is going to be also an opportunity, of course, a great challenge, but an opportunity to build something better. The second thing that I noted in your different speeches is that our strategy from the beginning to claim that being good in accounting and finance meant also being good in a variety of disciplines, including IT, technologies and stuff like that, but also being aware of the broader picture through social sciences and humanities is actually very relevant today. And we can still argue that knowing about accounting, knowing about finance is important. Understanding how they interrelate, intersect with technologies and social sciences and humanities and social relations is also very important. I would like to thank you again all for your interventions. And this closes our webinar. Thank you and goodbye.